You just heard my last guest make the case for why tariffs and a possible growth scare resulting from their implementation could be the biggest risk for the market this year. Well, my next guest sees it differently. Joining me now is Nancy Tengler. She's CEO and Chief Investment Officer at Laffer Tengler Investments. Nancy, it's great to have you here. And I thought Tim made a point, and it's a point shared by many, that tariffs, not so much as a long-term inflationary issue, really more from a growth scare. Could they slow down the consumer? Could they slow down the economy, that is looking pretty solid right now? What do you say?
Hi, Kelly. Thanks for having me. I think it depends on what the tariffs look like, but we have history. So we know that Trump 1.0 initiated tariff rates. I think when he came into office, tariffs on China are around 3%. By the time he left, they were a little bit over 9%. And at the end of the Biden administration, the rate is 10.5%. And yet we haven't seen the consumer pull back in any meaningful way. I mean, certainly from time to time and during COVID. But I think that this whole notion that tariffs are going to derail the new Trump economy is not accurate, just based on history and based on what we know the objectives of the administration are. So I'm more focused on earnings growth, and I know that that's the point of Tim's comments, that he thinks it will slow earnings growth and consumer spending. I just don't see it, especially with the productivity booms that we're seeing and have seen for the last 5 quarters.
What's fascinating is, despite divergent views on the tariff issue, there's actually stocks that you both really like. I mean, he mentioned Amazon. That's one of your favorites as well. Broadcom, Goldman Sachs. So this is why I love the market. You can kind of be right for the wrong reasons or wrong for the right reasons, or both, I guess we would say here. Just going back to the tariff thing for a second, as you said, the rate only went up from 3 to 10%. Now it's 11% or so. When I hear, when I read the Steve Moran paper, when I listen to Besant and think about they have a short period of time now to really kind of hit the ground running. I wonder if they're trying to be a lot more ambitious with tariffs this time around. Maybe that's wrong. Maybe it's meant to come across that way simply as a bargaining point. But what if that rate goes up, more than it did the first time around?
I think it's rhetoric, personally. I do think it's a negotiating tactic. And let's remember that we were 100% tariff driven pre-income tax in the 1800s. So I think it just matters how it's implemented and who is tariffed. In the same period that we were raising tariffs on China, we were lowering them on Vietnam. So I think it's really a country by country negotiating tactic that this administration intends to use to its advantage. I don't see, China's exporting deflation. Oil prices, if the energy policies for Trump 2.0 come through, will probably drive the cost of energy down. So I think there's going to be a lot of mitigating factors. And if you get regulatory relief and corporate income tax cuts and the individual tax cuts say the same from TCJA, I think this economy roars. And I think we continue to see productivity really add non-inflationary growth, and that's going to be good for everybody.
So I've mentioned there's actually quite a few different places that you can look to find stocks that you like right now. ServiceNow is another name. Spotify comes up. How would you describe the places where you feel less confident that things will go, whether with sectors or maybe it's factors or, size, that sort of thing?
Yeah, so I think consumer staples is an area that we're significantly underweight to. The only consumer staple we own is Walmart. We got out of the Pepsis and Cokes. I think that's an important place to not just buy an index, because I think that sector is going to continue to underperform. Super high dividend yield is probably going to continue to underperform. We like growth. The growth earnings are 16% expected next year versus 9.3 for value. So I think if we're in an environment where the economy is slowing as it did in the fourth quarter, but then reaccelerating, you want to own the names that are going to drive the reacceleration in the growth. So we're still overweight industrials, technology still, and for a while we think, and we think you want to stay away from the healthcare, consumer staples. Those are not areas where we're overweight.
All right. That is it. That is the world in a nutshell. Nancy, really appreciate it. Thank you as always. Nancy Tengler,
Thanks, Kelly.
Laffer Tengler.